Good afternoon and welcome to KPMG's LinkedIn Live. Today's discussion features Peter Torrente, KPMG's National Sector Leader for Banking and Capital Markets, and our guest, Tom Michaud, President and CEO of KBW. KBW, an investment bank focused on the financial services sector, is a subsidiary of Stifel Financial. KBW's highly regarded bank research team has the broadest coverage of the banking industry on Wall Street, covering not only the nation's largest banks, but most of the leading regional banks as well. And now for our presentation.
Tom, welcome. Great to see you again. Boy, it seems like since we were together last quarter, the outlook seems much more positive for the industry. And as we head into bank earnings season, just wondering if you could share with us what you see as the narrative for the industry as we sit here on the precipice of earnings outlook.
Well, Peter, first of all, it's great to be with you again, and thank you for having me. I think that there are going to be a couple of key pieces to the narrative about the banking industry in this quarterly earnings period. As you know, this week actually is a big week. 9 of the top 10 banks in the nation are going to report earnings this week. And I think the first part of the narrative is going to be that credit quality continues to be exceptional and continues to exceed expectations. It's really been remarkable how strong this credit cycle has been during the pandemic and the recession. And that's both in terms of identification of or the appearance of problem assets, as well as loan losses themselves. The second part of it is going to be the record-breaking investment banking quarter that the big banks are going to have. In our opinion, this will be the biggest quarterly revenue report for the big bank investment banks since the 2009 global financial crisis. So there's going to be a lot of talk about capital raising as well as sales and trading activities being robust. And then there's also going to be talk, I think, about just the outstanding quality of the balance sheets for the banking industry, both in terms of capital levels and as well as the liquidity in the balance sheet. We think there's $800 billion of excess liquidity on the banking industry's balance sheet, and that can all be turned into more profitable usage going forward as the economy recovers. The one negative on the horizon, though, is we expect there to be minimal revenue growth, or we would not be surprised if revenues were flat for the industry outside of investment banking revenues. And that's primarily because there's been very little loan demand in the economy, and net interest margins continue to be very low as the short end of the curve continues to be tethered around zero. So even though there's been a pickup in 10-year bond yields, the short end of the curve is close to zero, which really hasn't been generous to net interest margins. And so I think that's going to be the narrative. Great balance sheet quarter, strong investment banking quarter, but we're still waiting for the economy to pick up to really start to drive more revenue growth.
And Tom, maybe if we drill into the revenue growth a little bit, we see maybe banks responding in a variety of ways to the tough challenge environment. What are you seeing?
Well, I think that we have seen a real pickup in renewed efficiency initiatives. And that's been a popular theme over the past year to this tough environment. And the last time we studied this, we found that 80% of the expense initiatives also included branch closures. And I think that's going to be one of the big conversations in the banking industry, which is how has technology and digital adoption changed the use of the branch? And what can banks do to make themselves more efficient? Because that's going to be required to drive earnings growth in a difficult revenue environment. Now, also, too, I want to let you know, Peter, we don't think that this difficult revenue environment lasts. Our view is that it probably continues for at least another couple of quarters. It's not a question of if, it's a question of when. But we've got to burn through some of this excess liquidity in the system, as well as the heightened stimulus that's replaced a lot of the bank lending until we can get to the moment where we can maybe see some improved revenues. So we expect to see a heightened interest in cost savings programs as well as efficiency programs in the industry.
Yeah, we're seeing and hearing a lot of the same as we talk to our clients. And maybe on that revenue side, you mentioned the investment banking side. with SPAC transactions having been extremely hot the last 6 months. What are you anticipating, or any current thinking, just based on some of the news that's come out earlier this week, where it looks like maybe the brakes are being put on that, at least temporarily?
So first of all, it's been remarkable. There's been $100 billion of SPAC proceeds raised. That's more than all of last year. And I think it's even more of the whole period from like 2015 to 2019. So it's really been remarkable. I believe that the SPAC method of helping companies go public, which really, that is what that tool is in that path. I believe that even with some modest modifications, it could still be an effective tool. But the big issue here, Peter, is the last several years saw a remarkable amount of investment into private companies in America. There was a really robust private capital market raising effort or period, for primarily directed towards private equity, but also for wealthy individuals as well. Those shares need to come out of that private market. Now, maybe those companies get sold and via M&A, or they go public in a more traditional IPO instead of this SPAC. I believe that this SPAC process has been somewhat of a substitute for a more traditional IPO path. And if for some reason the regulations are changed and this SPAC process is no longer as attractive, I think that capital will still be raised, but it'll be raised via a more traditional IPO format.
And Tom, maybe looking past the quarter, again, we've seen M&A transactions announced as recently as this week, and obviously it's been a pretty active market. What do you expect for sort of spring, summer from the M&A market?
I think it has a chance to be very robust because of the drivers in the industry. So remember, pre-COVID, the industry was beginning a consolidation wave. And the drivers then were the fact that for the first time, at least in my career, the bigger banks looked like on a sustained basis, they were going to be more profitable. And that scale was really starting to work. And so I think there was an acknowledgement to that there was scale in terms of size and being a banking company. There also at that time was some concern that technology and digital engagement and non-banks could really start having an impact in the industry, and that more attention and investment was required from that perspective. Well, then the pandemic happened, and on the back half of the pandemic now, we believe that scale argument is probably still going to work, but the fintech and the digital investment argument, I think, has only been enhanced. I think a lot of the trends that would have taken years to unfold happened in a matter of months. And a lot of the banks have come out with usage statistics, which are really remarkable, that shows the amount of uptake in terms of participation by their clients via digital delivery. And I think also too, that's going to intertwine with that expense comment I said earlier, where banks might become a little bit less needed. Branches may be a little bit less needed. And you may have more of a reliance on digital delivery. And so the need for that investment, I think, is also going to contribute to consolidation. So I think it's two major things. It's scale is working, and we're in a tough revenue environment. So cost saving efficiencies can help you grow earnings, combined with the need to make more technological investments or technology investments. I think that is going to drive more consolidation. And I think that's going to be a common theme you see in future bank mergers.
That makes sense from what we're hearing as well. Maybe another topic that has been accelerating on the board agenda, management team agendas at the banks is ESG. And maybe we'd just be interested in your views on what you're hearing as you work with your clients, and is ESG a differentiator over time?
Well, we look at it from a variety of different angles. And the answer to your question is absolutely yes. It is going to be a bigger impact, and it's become a really big impact right now. And so let me talk about the different ways that my firm and our firm in KBW touches all this. Is number one, we research the asset management industry. One of the fastest growing verticals are ESG themed investment vehicles, whether they be ETFs or other vehicles. And over time, we expect ESG focused investors to own more of corporate America. So those funds are going to demand it. And while we don't see it quite yet, you may see one day where there could be a valuation impact from companies who score well on the ESG measures. That's one angle. The second angle is that our opinion is that the practices of corporate America are going to need to intertwine it into their operations. And we're doing that at our firm as well, as we consider all the different aspects to ESG. And it's just becoming more of what we do every day and how we operate and manage our company, as well as how our research department assesses investments and companies, because they believe that over time, this is going to become an important success variable. But for now, I think the first step as far as corporate governance goes, it's going to be a very binary type thing, which is the marketplace is going to probably develop some type of scoring mechanism where the market's going to believe either a company has sort of passed that test or has not passed that test. That's usually the first step. And then the second step is, I would imagine over time, there'd be an idea around grades of performance. And so I think it's critical. I think it's happening in the financial services industry. I think it should be on every board of directors' minds about how that's impacting the operations of their company. And I do think that it's an important part of governance that should be thoroughly and properly examined.
And Tom, maybe we'll wrap up where we started on the outlook. Definitely seems to be relatively positive, but maybe wrap up with a final question on the outlook on the economy and maybe some of your views on how you see the next 12 to 24 months playing out.
Yes, we've had a tremendous amount of fiscal stimulus, record amounts, almost like not since the last World War have you seen this type of government injection into the economy in such a short period of time. So when you look at that, you realize we're in an unusual moment. So you don't see it right in the numbers yet, but then there's what the management teams are telling us and what we see. There's no question the amount of animal spirits in the economy are building. I'm seeing hiring be better throughout the industry. And then we also at KBW more specifically have created something called the Restoration Index. The Restoration Index marked the economy at an index score of 100 pre-COVID. And we've been measuring it every step along the way. And our last score on that index last week had it at 83.6, which is a post-pandemic high. That means that economic activity is at 83.6% of pre-COVID levels. And if you're to take the slope of improvement, you could see that we recapture all the lost economic activity by the end of the year. So my opinion is as vaccines continue to roll out, the degree of government incentives, whether it be via stimulus or low interest rates, are really going to help continue make this recovery happen. And when you look at the Restoration Index and how that's been improving, it leads me to believe that we're in for a really strong period. We've been modeling more than 5% GDP growth for this year. And my own instincts are it has a chance to be that good or possibly even better.
Yeah, it's nice to be sitting here with a more optimistic outlook than we've had over the last 12 months for sure. And certainly a lot to develop over the next several months. So look forward to chatting again in the second quarter close. Thanks again, Tom, for joining.
Great, Peter, great to be with you. Thank you.